Revenue recognition follows one simple principle. Recognize revenue when control of goods or services transfers to the customer, not necessarily when cash is received. Whenever you see a revenue question, think through the 5-step model using the acronym I-STAR. Identify the contract, separate the performance obligations, determine the transaction price, allocate the transaction price, and recognize revenue. Step 1 is identify the contract with the customer. A valid contract exists only if all of the following are true. Both parties approve the agreement, each party's rights are identifiable, payment terms are identifiable, the contract has commercial substance, and collection is probable. Remember that contracts may be written, oral, or even implied. No valid contract means no revenue, even if cash has already been collected. One common trap is recognizing revenue simply because cash was received. Cash alone does not create revenue. If the contract changes, ask whether the modification should be treated as a separate contract. It is accounted for separately when additional distinct goods or services are added, and the price increase reflects their standalone selling price. Step 2 is identify the separate performance obligations. A performance obligation is a distinct promise to transfer a good or service. A good or service is distinct if the customer can benefit from it on its own, and it is separately identifiable from the other promises in the contract. One contract may contain multiple performance obligations, so always ask yourself, is this one promise or several promises? Bundled products frequently need to be separated. Step 3 is determine the transaction price. This is the amount the company expects to receive. It may include fixed consideration, variable consideration, performance incentives, and even non-cash consideration. Companies estimate it using either the expected value method or the most likely amount method, but the estimate is constrained, so revenue is not recognized if it is likely to reverse in the future. Step 4 is to allocate the transaction price to each separate performance obligation based on relative standalone selling prices. If a standalone selling price is not directly observable, it may be estimated using an adjusted market assessment approach, an expected cost plus margin approach, or, in limited situations, the residual approach. Remember that allocation determines how much of the transaction price belongs to each performance obligation. The timing of revenue depends on when each individual obligation is satisfied. Step 5 is recognize revenue when or as the performance obligation is satisfied. This is one of the most heavily tested areas. First, determine whether revenue is recognized over time or at a point in time. Revenue is recognized over time if any one of 3 conditions is met. First, the customer simultaneously receives and consumes the benefits as the company performs, such as a subscription service. Second, the company creates or enhances an asset that the customer controls as it is created, such as construction on the customer's property. Third, the asset has no alternative use to the seller, and the seller has an enforceable right to payment for work completed to date. If none of these conditions are met, revenue is recognized at a point in time when control transfers. Indicators that control has transferred include the customer obtaining legal title, physical possession, the significant risks and rewards of ownership, the seller having a present right to payment, or formal customer acceptance. When revenue is recognized over time, progress must be measured. Input methods measure what the company puts into the project, such as labor hours, resources consumed, or costs incurred divided by total expected costs. Output methods measure what the customer receives, such as units delivered, units produced, or milestones achieved. For construction contracts recognized over time, remember the gross profit workflow. First, calculate total expected costs by adding costs incurred to date plus estimated remaining costs. Next, calculate the percentage complete by dividing costs incurred to date by total expected costs. Then determine the total expected gross profit, which equals contract price minus total expected costs. Finally, calculate gross profit earned to date by multiplying total expected gross profit by the percentage complete. If the problem asks for current year profit, subtract any gross profit recognized in prior years. Know the rules for contract costs. Incremental costs of obtaining a contract, such as sales commissions, are capitalized if they are expected to be recovered. However, if the amortization period would be 1 year or less, the company may elect to expense them immediately. Costs that are not incremental, such as travel, salaries, or general administrative costs, are expensed immediately. Costs to fulfill a contract are capitalized only if they relate directly to the contract, generate or enhance resources that will satisfy future performance obligations, and are expected to be recovered. Otherwise, they are expensed as incurred. For contract modifications, first ask whether additional goods or services are distinct and whether the price reflects their standalone selling prices. If both conditions are met, account for the modification as a separate contract. Otherwise, it becomes part of the existing contract. FAR usually tests whether the modification is separate or combined rather than the detailed accounting mechanics. Know the difference between a principal and an agent. The key question is who controls the goods or services before they are transferred to the customer. A principal controls the goods or services before transfer and records gross revenue. An agent simply arranges for another party to provide the goods or services and records only the net commission earned. Several special revenue situations are commonly tested. One of the most important is the repurchase agreement. A repurchase agreement occurs when a company sells an asset but either may or must buy it back later. The key concept to remember is that if the seller retains control through repurchase rights, revenue usually is not recognized because control has not truly transferred to the customer. There are 3 types of repurchase agreements. A forward requires the seller to repurchase the asset. A call option gives the seller the right, but not the obligation, to repurchase the asset. A put option gives the customer the right to require the seller to repurchase the asset. If the seller has a forward or a call option, compare the repurchase price with the original selling price. If the repurchase price is less than the original selling price, the arrangement is accounted for as a lease, not a sale, because the customer is essentially paying to use the asset temporarily. If the repurchase price is equal to or greater than the original selling price, it is treated as a financing arrangement, not a sale. The seller continues to recognize the asset, records a financial liability for the cash received, and recognizes interest expense over time. If the customer has a put option, compare the repurchase price with the expected market value of the asset at the repurchase date. If the repurchase price is less than the expected market value, the customer is unlikely to exercise the option, so the transaction is generally accounted for as a sale. If the repurchase price is equal to or greater than the expected market value, the customer is likely to exercise the option, so the arrangement is generally accounted for as a lease or financing arrangement, rather than a sale, depending on the specific facts. A simple memory trick is this: forward equals seller must repurchase. Call equals seller can repurchase. Put equals customer can force repurchase. Then ask yourself one question: has control really transferred? If the seller still effectively controls the asset because of the repurchase rights, revenue generally should not be recognized. Now let's move on to a bill and hold arrangement. Revenue may be recognized before delivery only if there is a substantive business reason for the arrangement, the product is identified as belonging to the customer, it is ready for physical transfer, and the seller cannot redirect it to another customer. Under a consignment arrangement, revenue is not recognized when goods are shipped to the consignee because control has not transferred. Revenue is recognized only when the consignee sells the goods to the end customer. Warranties are another favorite topic. An assurance-type warranty guarantees that the product will function as intended. It is not a separate performance obligation. Estimate warranty expense and record a warranty liability at the time of sale. A service-type warranty provides additional services beyond basic assurance and is often optional or separately priced. It is a separate performance obligation, and revenue is deferred and recognized over the warranty period. Finally, remember sales with a right of return. Revenue is recognized at the time of sale only for the amount expected to be kept by customers. Record a refund liability for expected customer refunds and an asset for the right to recover inventory expected to be returned. Returns are estimated at the time of sale, not when the customer actually returns the product. To tie everything together, always remember the workflow. Identify the contract, identify the promises, determine the price, allocate the price, and recognize revenue when control transfers. Whenever you see a revenue question, first determine whether revenue is recognized over time or at a point in time, then apply the appropriate rules. Most revenue recognition questions become much easier once you identify where you are in the 5-step model.